The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Gold has surged to unprecedented levels this year, breaking above $3,600 per ounce and marking a gain of nearly 38% in 2025. Now, the rally has been driven by a confluence of factors. This dramatic surge has sparked renewed interest in gold as both a hedge against uncertainty and a potential investment opportunity. So what are the forces behind gold's rally? What are the potential risks and market sensitivities? And what should investors consider as they navigate these historic highs? Well, to find out more, I'm joined by Stephanie Leung, who is the Chief Investment Officer at StashAway. Hi, Stephanie. Welcome to the show.
Hi, thanks for having me.
Thank you so much for joining us. Well, Stephanie, gold prices are hovering near a record high, holding firm above that $3,600 level. Why are gold prices skyrocketing? What's driving this upward trend?
Yeah, I think at StashAway, we've allocated to gold since April last year. And the reason why we made the allocations to gold is because of two things. Number one, traditionally, if you think about kind of asset classes in general, gold serves as what we call a defensive asset class, meaning that it has typically have negative correlations to risky assets like equity. So when equities goes down, things like bonds or gold typically would provide a very, very good cushion for a multi-asset portfolio. So hence, we include typically some bonds and some gold as defensive assets to balance out the risk in riskier assets like equities. Now, if you think about kind of defensive assets, there are a few choices. Number one is, of course, you can put things in cash, which is the safest of all, but it doesn't generate very good returns. But the other kind of common defensive assets, it's bonds. And of course, like the other one is gold. So last year, what we did was that we moved away from bonds into gold. And the reason for that is exactly, I think, why gold is surging right now is that if you think about gold as an alternative to sovereign assets, basically it's an alternative to US dollar, it's an alternative to the euro, it's an alternative to the yen, etc. And I think that is kind of what's driving gold's return. Very, very strong return year to date is basically that a lot of investors are looking at the debt profile of a lot of these governments in the next 5 years or 10 years and find that some of the fiscal positions may not be sustainable. So gold serves as a very good hedge for both inflation and also increase in government debt over time.
Right. Well, Stephanie, how sensitive is gold to, U.S. labor data, inflation prints, and the upcoming Fed decisions? If all goes to gold's favor, will it be a short-term lift for prices, or could prices go up for the longer term?
Yeah, I think we've seen in recent weeks that U.S. data has been weakening. So the latest labor market data from the U.S. shows that a lot fewer new jobs were added. And I think at the same time, the inflation picture is not very, very clear that inflation is coming down quickly. So I think that creates a very kind of good environment for gold. And hence, I think you've seen gold kind of have a breakout in the last 2 weeks or so. And I think this situation is something that we've been highlighting for quite some time. So if you look at, the US economy right now, growth, although employment data has been weakening, growth is still relatively okay. But the problem is that inflation is not coming down as quickly as the central bank would like, or what a lot of people would like to see. And in that backdrop, actually gold does very, very well because of the inflation hedge property of gold. And also, if you look kind of forward into the spending by not just President Trump, but also in other parts of the world, for example, Germany, we've seen in the latest kind of UK data, the UK bonds are actually falling in value and yields are actually at close to all-time highs. I mean, all these are kind of supportive environments for owning gold. I think added to that, if you look at who's been buying gold, central banks have actually been one of the biggest buyers of gold in the last 2 years, and that trend is still continuing this year.
I see. Well, then, Stephanie, if the Fed surprises with a smaller than expected rate cut or none at all, how quickly would the gold market react?
Yeah, I think the market is now looking for the Fed to cut in its September meeting and also perhaps into year-end one more cut. So that's sort of already in the market. Now, if the US data actually slows down even more in the sense that interest rates come down even quicker, then I think if you compare gold versus holding holding cash because gold actually don't pay you any interest rates, right? And the alternative is really, okay, if you don't buy gold, you leave money at the bank, that pays you some interest. Or if you go buy government bonds, that also gives you some interest. Now, if the interest rates on that cash or that bonds comes down, relatively speaking, you're not losing so much on gold, given that it doesn't pay any dividend or doesn't pay any yield. So from that angle, interest rates come down faster, then that actually adds to the case for owning gold over owning other defensive assets like cash or bonds.
Well, on that note, then, what other factors could derail this rally in the short term?
I think inflation comes down quicker than expected. And I guess there is a positive development in terms of fiscal constraint, i.e., I think, for example, if you look at what the Trump administration had tried to do in the first half of the year, they were talking about cutting government expenses, right? And making kind of fiscal adjustments so that the government budget becomes sustainable over the long term. I think if there is real effort or kind of real breakthrough in cutting costs, that could bring down kind of long-term interest rates. And I think that could actually make bonds, long-term government bonds, more attractive. However, I think that is a very, very hard thing to do. So I think barring that from happening, the bigger trend is still that central banks are diversifying away from US dollar holdings, particularly for emerging market central banks like China, like India, like Russia. These banks have been buying gold, and I think that would still continue.
Well, with gold prices hitting record highs here, Stephanie, are we due for a correction soon?
I think if you look at gold for the price action this year, during the first kind of 4.5 months or so, I mean, gold has done really, really well. And I think gold was up 30-something% into the trade war, given that there's a lot of concern in the markets. And what we've said back then, kind of a few months ago, was that, we thought gold was a bit overstretched because, going up 30-something% in 4 months is not very sustainable. Gold is not like Bitcoin, right? Gold doesn't move that quickly. Back then, I think what we told our investors was that we expected some period of consolidation. And indeed, gold consolidated since then, right? It's been kind of not going anywhere or trading in a range for the past kind of 45 months. And we think that with the recent kind of breakout, it may resume its kind of long-term bull trend again. So I wouldn't be too worried about kind of very, very short-term gyrations or pullbacks. Indeed, I think for a lot of investors, they don't have gold necessarily in the asset allocation. Most investors, if you think about the traditional portfolio, they have, let's say, 60% equity, 40% bond. There's no kind of gold allocation. And for these investors, we think it makes sense to really review your portfolios and see if there's a pullback, then it's probably a good chance to add some gold as part of the defensive allocations.
Definitely. Well, with gold's ascent beyond $3,600 amid soaring rate cut bets, what would be your expected trading range over the next 3 to 6 months?
We don't give sort of explicit targets, but I think, as I mentioned, I think gold is still in a very, very long-term kind of bull run. I think if you look at kind of historically, given gold's volatility, I think it's reasonable to expect sort of like perhaps mid-teens to kind of 20% return on an annualized basis in a bull run. So that is something that I would be looking.
Well, some experts forecast a mid-2026 baseline of $4,000 per ounce, with tail risk scenarios approaching $5,000 if private investors shift even a small portion into gold. So how plausible are these scenarios?
I think if you look at the base projection number, that is translating roughly to kind of mid-teens return, which is in line with the long-term kind of trend of gold. So I think that's pretty reasonable. As for 5,000, I think a lot of things need to happen. For example, I mentioned the concern about kind of fiscal sustainability, the sort of inflation picture, etc. So, there is, of course, a chance, but I would say that is perhaps an edge case. If you think about kind of multi-asset portfolios, right? If you hold equity, and you're concerned about the tail risk of, let's say, high inflation or more geopolitical conflicts or governments having problems with fiscal kind of situation, then, gold actually serves as a very, very good hedge. Because in those cases, those are exactly kind of risk scenarios where gold goes to 5,000. And in that case, your equity portion may be losing money, may be down because of all these concerns, but your allocation to gold would actually be up. And indeed, if we look at historical kind of equity drawdowns, typically gold would be going up when equity is in a sustained kind of bear market. So again, going back to my point of like having a good mix of defensive assets, for example, gold, to balance out the risk that you take in equities, I think that is kind of how we think about portfolio construction in StashAway, and I think that applies to like every investor.
Okay. Well, then overall, are we seeing increased flows into gold from emerging markets, especially in Asia, as a hedge against local currency volatility?
Yeah, I think it's perhaps is less so of a hedge versus local currency volatility, but I think if we look at kind of where a lot of the central bank flows are coming from, increasingly is coming from emerging markets. And I think that reflects the need or the kind of requirement to diversify more of the holdings away from traditional central bank holdings, for example, US Treasuries. And I think that is partly because of perhaps, rising geopolitical kind of frictions, but also partly because a lot of these central banks are looking to kind of diversify away from the US dollar. And I think this is a trend that has started about 2 years ago. And of course, with what's going on this year with the Trump administration, with the trade wars, I think that probably accelerates some of these trends going forward.
Well, with such momentum behind gold, then should investors tilt into physical bullion, ETFs, or consider alternatives?
Yeah, I think, of course, the safest or the most kind of physical you can get is just to get the bullions and put them into a safe. But it's also very cumbersome and it's not very easily transferable. You can't really transact, right? So I think gold ETFs actually offer a very, very good alternative. You don't have to worry about storage. You don't have to worry about transporting the gold. And you can basically buy and sell every day. So liquidity is excellent. And these days, for example, for the ETFs that we use at StashAway, they're listed in the US with very, very, very low management fees. So basically, you can enjoy all the benefits of a very liquid asset with the underlying, with the comfort knowing that gold ETF is actually fully backed by the bullion itself. So I think there's very, very little risk in holding the gold ETF versus holding the actual gold bar.
Well, overall, what are the biggest risks to gold maintaining its record highs, though?
I think, of course, it's done fairly well this year. So it's actually, if you compare gold versus equities and bonds, gold has outperformed all the other asset classes year to date. And I think, of course, there could be some profit taking. But I think these are kind of short-term gyrations, which are quite normal in the markets. And I think if you share our longer-term view of concerns on government's kind of fiscal spending, on high inflation for longer, then I think having a goal allocation and making use of these pullbacks to add to that allocation actually makes a lot of sense.
Speaking of allocations here, given the current momentum, should investors overweight gold in diversified portfolios?
So it really depends on the risk appetite and individual goals for investing. So, for example, at StashAway, what we have are managed portfolios. We have 12 different risk points. So, for the most aggressive investor, of course, most of the investments should still be in equities because equities over time still gives you the best return. But of course, having more equity means that you'll be kind of from time to time suffer more drawdowns because the markets don't go up in a straight line. And if for somebody who has lower risk appetite, then having a mix of gold, equities, and cash, or even like ultra short dated bonds, I think that gives you pretty good protection when equity markets suffer a drawdown. But still, all these asset classes could generate positive returns over time. Now, of course, compared to the more aggressive investor, the more conservative investor would have, in general, smaller returns over the long term. But of course, that comes with more stability for the portfolio as well. So I think definitely as that way we're overweighting gold compared to more traditional portfolios. But for individual investors, the mix actually the actual mix actually is determined by a number of factors that includes your risk appetite, your time horizon, etc. And what we do at StashAway is we help our investors to assess what is your requirement and then, what is the right portfolio mix for each individual investor.
Some great insights from you there. Thank you so much, Stephanie, for joining me today.
Thank you so much for having me. Have a great day.
That was Stephanie Leung, who is the Chief Investment Officer at StashAway. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.